Come September 1st, we might experience one of the biggest margin call because of something the DTCC has been working on since 2020, all right? And I believe this might be one of the big catalysts that potentially brings us closer to where we need to be with AMC stock and the short squeeze, if you know what I mean. So jumping into the DTCC website, guys, this is an article, this is a post from Bob Stewart. Bob Stewart is the DTCC Executive Director in charge of institutional trade processing. You can see here on May 6, 2021, he posted this: UMR, the time to automate is now. Okay, in less than 6 months, phase 5 of the BCBS ISOS uncleared margin requirements, UMR, for uncleared OTC derivatives will be implemented. That was, keep in mind, that was back in May, beginning of May, all right? So he's saying firms with more than 50 billion equivalent in average national amount in over-the-counter derivatives will be required to begin the exchange to initial margin with their trading counterparties beginning September 1st of this current year, if they exceed the minimum exchange threshold of 50 million per counterparty relationship. Without a doubt, phase 5 requirements will capture the largest number of firms that trade derivatives. And therefore, it is critical for those firms to be in compliance and get ready with these new rules. This is where it gets very, very interesting. They've been working for this since September 1st, 2020, and because of the pandemic, they gave a deadline for a year for all of those market participants and all of the firms matching those requirements to actually get prepared. But time's up, because it seems like a huge significant part of these companies, of these firms, are not ready at all. However, recent reports have indicated that a significant number of market participants subject to phase 5 are far from being ready to comply with the coming September 1st deadline. Now, it gets even more interesting because there was another post coming June 4th. Are you ready for UMR? Okay, again, Bob Stewart, same guy, posting, which kicks on September 1st, 2024. This is phase 5 of the UMR getting implemented for the OTC derivatives. There will be an upsurge in the volume of margin calls and an increase in the need for third-party custodians to safekeep collateral. As a result, UMR will likely require many buy-side firms to make significant changes to their existing collateral management processes. He continued, many of these processes are very manual today, often leading to transactional processing errors, okay, and settlement failures, like the FTDs they fail to deliver, which we know are through the roof when it comes to AMC. It is then critical that in-scope buy-side firms are well on their way to preparing for compliance. Now, keep in mind that this is solely targeting OTC, over-the-counter derivatives, meaning shares or assets that are not being traded in standardized markets like the New York Stock Exchange or the NASDAQ, right? Now let's jump over the definition of what an OTC derivative is. An over-the-counter derivative is a financial contract that is arranged between two counterparties, two banks, two hedge funds, two investment firms, whatever you want to put on it, but with minimal intermediation or regulation. So it's pretty much like Citibank calling Citadel, or Citadel coming Virtue, or two big guys saying, hey, I'm in need of getting X amount of shares of, I don't know, the swap or the future or whatever, okay? But instead of going into the market like you and I will go through, Robinhood, Fidelity, Webull, or whatever, they will just get together and say, hey, I buy you at this price. Do you agree? Yes, I do. Okay, deal. Let's make it happen. So there is little to no DTCC, no NSCC involved, no SEC involved, because it's over the counter, all right? It's like a private deal, if you wish. Now, the fact that it's the derivative market is really the biggest in terms of volume in the whole market in the globe, okay, on planet Earth. And that's why they need to bring regulation on this, because keep in mind, this is actually what we're seeing in AMC. As far as any time we get to those Fridays, anytime we get to, we were at the 60s, the 50, the 40, and now the 34, they will do anything possible in order to bring the price down. And they do that majorly through the options volume, the option contracts, the option market, all right? So that's why DTCC has been working on this, and it was supposed to come into play last September of 2020. But again, because of the pandemic, they get a year extension. But so far, it doesn't seem like these guys are ready. Now, this is where the bottleneck stands, all right? Listen to this. This is a paper that Citadel sent to the DTCC, all right? It was in May 2021. Remember, May 2021 was when DTCC, Bob Stewart DTCC sent out the first post about, hey, UMR, we have phase 5, and there are 6 phases in total. So on page 18, if you scroll down to page 18, it is where it gets really, really, really juicy. All right, let's get there. 16, 17, 18, boom, let's go. All right. Citadel is really trying to get an exemption, exempting the inter-dealer portion of the security-based swaps market for uncleared initial margin requirements undermines the regulatory objectives of mitigating systematic risk and promoting central clearing. In light of the above, all right, we recommend that the Commission reconsider the exemption from initial margin requirements for uncleared inter-dealing security-based swap transactions, which in this case is another example of the OTC derivative that the DTCC is kind of targeting to regulate. So I wonder why Citadel Securities, as big as it is, had an entire year, okay, to work on this and get prepared. They are not willing to be part of this regulation. They're not willing to be regulated. They want this to kind of have, okay, you know what, we gotta get a pass on this. For what reason? Because you're Citadel? No. Even though you are one of the biggest market maker in the US exchange now, in the US stock exchange now, I mean, you should be one of the first to be regulated. And this is not brutal, okay? This is not something that just came out of the blue. You all knew about this. So, according to my personal opinion, I think, by reading between the lines, they're willing to get an exemptions because this also ties to another regulation coming from Rule NSCC 0010, I believe. No, 11 or 5. Anyway, I'll have to make a separate video on that. But trying to get the requirements in terms of liquidity deposits from $10,000 to $250,000. This is 25 times more than actually what they were used to. So it means if they are already overextended in AMC shorting it, because it doesn't make any sense how so far they've been able to sustain those short positions, which we know are billions and in billions and in billions, okay, of synthetic fake shares, and millions of people still buying and holding week in and week out. If they were not as extended, if this was not a very big risk to their operations. So I don't know if you see what I mean. No, Citadel, sorry, you will not get an exemption, and what's supposed to happen will happen. Now, it doesn't necessarily mean that on September 1st we'll see the short squeeze happening and everybody will get the tendies, because we all know these guys always have something to some kind of trick to pull at the very end of the day. But there are so many things cornering them, so many things forcing them, so many things against their play that I don't think all of these are just a coincidence. But hey, we'll see. We still have 2 weeks, so more to come on this.